In this video, I'm going to show you how a married couple with $100,000 a year in income can legally owe zero taxes, and more importantly, I'm going to show you exactly how to build that plan yourself. Coming up next on Holy Schmidt.
Holy Schmidt!
Gang, what I'm going to show you is not some sort of complicated tax shelter. It's not some offshore scheme. It's solid tax planning. And unfortunately, most people, when it comes to taxes, plan on April 14th, and they do it for exactly one day as they're filling out their tax return or they're speaking with their accountant. What I'm going to show you today is a zero tax playbook using real numbers, 4 distinct levers, and a case study at the end to bring it home. All right, let's jump into it. Most people, when they retire, will have spent 30 or 40 years contributing to their 401k. It's their single largest savings account. It might be the source of all of their savings, in fact. And so the funds that they take out of that account are 100% taxable, like any 401k or IRA that doesn't have a Roth component. This, by the way, is the same tax rate that you would pay on your income when you were working, adjusted for the amount that you take out, because the more you take out, the higher your tax bracket, just like earned income. And here's where it compounds. Age 73. This is the age where, for most people, required minimum distributions come into play. And with required minimum distributions, there are often things like increased personal taxes, higher tax brackets, an increase in the IRMAA surcharge for Medicare, and additional tax on Social Security. The people who avoid these didn't just get lucky. They spent time with tax planning, and that time has brought their taxable income down, sometimes down to zero. The good news is that the tools that they're going to use are available to just about anybody, and if used correctly, they can bring taxable income down to zero in many cases. Now, in order to understand what we're going to talk about next, we need to talk about 3 income buckets. These 3 income buckets are pretty common. You probably will know exactly what I'm talking about, but it's important that we clarify what these are and how they work. The first is the tax-deferred bucket. That's a 401k or an IRA. Basically, this means you contribute to your investment account with pre-tax dollars, and that goes into the 401k or IRA. It grows without any tax on the growth, and then when you take the funds out, you pay ordinary income on the withdrawal. This is what most people do when it comes to retirement. Bucket number 2 is your Roth account, a Roth 401k or a Roth IRA. And with this account, you put money in after taxes, and all of the growth accumulates, and when you take the funds out, you don't pay taxes on anything you take out. Now, bucket number 3 is your brokerage account, and activity in this account is taxable, but with certain caveats. If you have capital gains, sometimes the capital gains are taxed at zero. It depends on the nature of the capital gain. Dividend income is taxable, but often at a lower rate, and interest income is taxable. All right, now let's talk about lever number 1, the 0% capital gains bracket. Most people don't know this exists. If you're married filing jointly in 2026 and your taxable income is under roughly $98,900, your long-term capital gains rate is 0. That means if you've been building assets in a taxable brokerage account and you sell those assets alongside, say, a 401k, if you keep your income level down to approximately $98,000, $99,000, you're not going to pay long-term capital gains on those assets. And here's a bonus point, tax gain harvesting. If your income is low enough, the threshold that we talked about before, married filing jointly that is, you can actually sell appreciated assets that have a gain and recognize that gain and still not pay taxes on it, and then use the funds that you received from selling those assets and redeploy them with a higher basis. Lever number 2, the Roth conversion window. This is the most powerful lever most retirees leave on the table. This window opens the day you retire and closes the day you turn on Social Security. Here's how it works. You retire at 62 and you delay Social Security until 70. Those 8 years, your income drops dramatically. You're in the 12% or maybe 22% bracket. You convert traditional IRA money to Roth every year, pay taxes now at a known rate while your income is temporarily lower, and the money is tax-free for the rest of your life. And most importantly, Roth withdrawals don't increase your taxable income. That means that they don't increase your tax on Social Security and they don't increase your IRMAA surcharges in the future. That's the real advantage of filling your Roth bucket before you need it. When you wait to claim Social Security until age 70, the maximum benefit, your Roth account helps shield you from required minimum distributions. The people who do this right can cut their tax bill by hundreds of thousands of dollars. Lever 3, Provisional Income Management. Up to 85% of your Social Security benefit can be taxed as ordinary income. What determines how much? Your provisional income, which is your AGI plus half your Social Security benefit plus any tax-exempt interest. If a married couple keeps their provisional income below $44,000, for example, only 50% of their Social Security payment is potentially taxable. If you can engineer your withdrawals to stay under that threshold by drawing from Roth instead of traditional, you can dramatically reduce how much your Social Security gets taxed. Lever 4, the age 65 plus deduction stack. This one's new for 2026. If you're married and you and your partner are both 65 or older, here's what you can stack up this year. First, you have a standard deduction of $32,200. Then you have an age-based additional deduction of $3,300. And then there's the new 65 plus bonus deduction from the One Big Beautiful Bill, which is up to $12,000. Now that's $12,000 as a couple or $6,000 per person. That's an important distinction to note here. That's $47,500 in tax deductions before you pay $1 in federal income tax. Then you overlay your Roth withdrawals and your 0% capital gains treatment, and you can see how someone can get to $100,000 or pretty close to it and not have any tax due to the federal government. Now, gang, you can do this all in your head, or you can put it on a sheet of paper and probably figure it out, at least short term. But I mentioned at the beginning of this video that a lot of tax planning happens on April 14th, and that's because people don't have an advanced planning tool. Now, I recommend and personally use Boldin personal financial planning software. It's a wonderful tool that runs about $12 a month. The most important part is that if you've never used Boldin, they give you a 2-week free trial of their full-featured software, and if you decide to keep it, after that you pay $12 a month paid annually. It's something that I personally use. If this is of interest to you, you can use my affiliate link at go.boldin.com/Schmidt and try your 2 weeks immediately. And after that, if you decide to keep it, as I said, it's $12 a month. Now, before I get into the case study, I need to warn you about the one trap that catches people who think they've nailed this. It's called IRMAA, the Income-Related Monthly Adjustment Amount. It's a Medicare surcharge, and it can blindside you. Here's how it works. Medicare Part B and Medicare Part D premiums are based on your income not from today, not from this year, not from last year, but from your income 2 years ago. And if your income exceeds certain thresholds, your IRMAA surcharges go up, and they don't go up in tiny bits. They go up in pretty big steps. In 2026, a single filer with income above $109,000 hits the first tier. A married couple above $218,000 also hits the first tier. At the highest tier, your Medicare Part B premium can reach $689.90 per person per month instead of the standard $202.90. That's nearly $5,900 per person per year extra just in Part B. The critical mistake is that someone does a Roth conversion to lower their taxes in the future, which is smart, but they don't realize that since the IRMAA surcharges are based on income from 2 years earlier, that's going to trigger an increase in their Part B and Part D premiums in the future. You can engineer a wonderful zero tax plan and end up paying an additional $10,000 in IRMAA surcharges just by not knowing that this rule exists. The fix is to model both simultaneously, your income tax outcome and your IRMAA outcome 24 months in the future. And understanding what they are together is really important if you want to minimize your costs in retirement. And by the way, that's why a CPA who understands retirement planning, in many cases anyway, is worth every dollar that you pay them. It's also something that you can model in the Boldin software under scenario planning. Now we're going to talk about my two favorite people, Callum and Marvin, again. Callum and Marvin are twins born 10 minutes apart and 1 day apart. They came from the same family, same upbringing, had the same income while they were working. Both were quite prudent in terms of what they saved, but they both had vastly different retirement outcomes. Each had saved $1.5 million, $900,000 in a traditional IRA, $400,000 in a Roth, $200,000 in a taxable brokerage account. Both plan to spend $90,000 a year, and both will get $2,400 a month in Social Security if they claim at age 67. Marvin does what feels natural. He starts withdrawing from his traditional IRA at 62, claims Social Security at 65. By the time his RMDs kick in at 73, his traditional IRA has grown to over $1.1 million. His RMDs force him to take $44,000 a year on top of his Social Security. He's pushed into the 22% bracket, and 85% of his Social Security is taxable, and his Medicare premiums get surcharged. Callum does it differently. From 62 to 70, he converts $60,000 a year from his traditional 401k to a Roth at 12%. That's his tax rate. At 70, he turns on the maximum Social Security benefit. His traditional IRA is much smaller, and his RMDs are manageable, and most of his income comes from tax-free sources. Over 25 years, Callum pays roughly $180,000 less than Marvin, despite the fact that they were both diligent in saving and were very prudent in how they spent their money. Same spending, but different decisions about sequencing and timing. And that's the playbook. So let me recap the 4 levers. 1. Use the 0% capital gains bracket while your income is low. 2. Execute Roth conversions during the retirement window before Social Security is turned on. 3. Manage your provisional income to reduce Social Security taxation. 4. Stack the 2026 age 65 plus deductions to shelter the first $47,500. And the trap to avoid, watch your IRMAA thresholds. Don't let a Roth conversion trigger a Medicare surcharge that offsets the tax savings you just created. The couple that pays zero taxes on $100,000 isn't a fantasy. It's a plan, and it's one you can build right now while you still have time to execute it. If you want to model your own numbers, don't forget to try Boldin free for 2 weeks. Go to go.boldin.com/Schmidt to get your 2 weeks free. After that, it's just $12 a month paid annually. Also, if you like this video, check out that video. 74% of retirees failed this basic retirement question. This is Jeff Schmidt, and I will see you in that video right there.